And welcome to this video. Today I want to show you a little trick how you can assess if it's too late to buy into a stock. A lot of traders struggle with that. So when they look at a stock, they ask themselves, okay, should I buy now or is it already too late? And sometimes they have no clue how to assess if it's too late to buy into a stock. And I have two things what I always have into my mind when I look at a stock and try to assess if it's too late to buy into it or not. And I ask myself two questions. The first one, is it extended in price? And the second one, is it extended in time? And is it extended in price? It's very simple to answer. So if you look at the original base, so before a trend started, so the long-term base, and in that case here, it's for the stock ELF, it is the base here. So you can see the stock is going sideways for a couple of months here and undercutted the EMA 200, the EMA 65, which is a red line. So it had a correction and built a correct base. In that case, it's not a cut base, it's more, I would say, a double bottom here. So you can see that here. And this is the original base. And when you now look at the breakout level here, so this is the red line, where the price reached a new high, and now you look at the current price, you can see what is the distance. So in that case here, ELF, the distance is 160%. So 160%, that means the stock already had a very, very strong price move from the base. And 160%, I would definitely say, yes, it's extended in price already. So, and everything what is, depending on the stock, of course, but everything what is 20%, 30, 40, 50% above the original base is usually extended. For slowing or for slow moving stocks, something like large cap stocks, Netflix, Apple, whatever, it could even be 15%. For high growth names, stocks which really, really move fast, it could be, 50 to 70%. There is another way to see if a stock is extended in price, and this is when you look at the weekly chart and you look at the distance from the black line here. This is the EMA 40, by the way, and you look to the current price. So, and this indicator, the distance from 200 MA here, this is measuring the distance from the black line to the price. So in the weekly chart, it's the EMA 40. And here you can see the stock is extended by 60%, or was extended by 60% when the price was around the highs here. So I always tend to say 70% is really extended, and you should take or should think about taking profits here. And when you look back at the price history here, you can see that every time the stock moved to this trend line here I drew into the chart, the stock had a pullback. So this is what I call a natural pullback level for a stock. I teach that to all the members, and you can see here for ELF, the natural pullback level is around 20%, 25%. So every time when the stock reached 25%, a distance from the weekly EMA 40, the stock had a correction or pullback. So, and now the stock is at 60. So this is super extended. And you can see that even if you look here at the trend of the stock, yeah, the trend is very, very strong, but it looks like an acceleration, right? So these are three things how you can assess if a stock is extended in price. What is extended in time? Extended in time means you have a trend which already runs for a couple of weeks or months. So what is extended in time? Well, this is also a little bit discretionary, so there is no 100% objective measurement for that. But if you look here at the trend of ELF, you can see from the base breakout, so from the original base, the stock moved higher for 4 months, 9 months now. So that is a lot of time, and a lot of institutions, a lot of traders already know the stock because it's so it moved so strong in price that everybody is aware of that, and they had so much time to buy into the stock. So this is a stock which is extended in price and in time. And I would say, everything what is more than 3, 4, 5 months starts to become extended in time. It always depends on the stock. Some stocks become extended in time a little bit earlier. Some become a little bit later. So, but this one here is definitely extended in price and in time. So the trend moved already for 9 months. So you must ask yourself the question: how much gas is left in the tank? So these are two things and two questions I always try to answer myself if I look at a stock. There is another approach, and the another approach is to look at the pullbacks or at the bases during the trend. So, and you can see that here is the first real pullback to the EMA 65. Here's the second one. Here is another deep pullback. It reached not the EMA 65, so the red line here in the chart, but it was a deeper pullback and undercutted the EMA 21. So this is the first base here, this is the second base, and this is the third base. And I have a very simple rule. So the first base is great to buy. The second one is also okay. The third one is something you should be very careful with. And the fourth and the fifth base is something you should avoid. Why avoid? Because the stock is already too extended in price and in time. Everybody knows the stock. All the institutions are already invested. And the longer a trend goes on, the more capital flew into the stock. And there is not much gas left in the tank. So this is something you must always keep in your mind. So I bought the stock here on the third base, but I sold it around this 90 level. Yes, I did not catch the top here, but I sold that and took the profit. Why did I took the profit here and not let the stock run? What I usually do. There were two reasons. So the first one, the market was not in the best shape. But the second one is it's the third base. So there is not much gas left in the tank. That's what I wanted to say. So, and I know that because it's already the third base here. It would be different if it's the first base. Then I would give the stock a little bit more room, but it's the third base and I want to take the profit because I know that already some institutions maybe look for reducing their position, and there are not many traders on the sidelines who want to come into the stock. So, and again, so the first base is a good buy, the second one is also good, the third one, be careful, take profits when you have them, and the fourth one and the fifth one is something you want to avoid, especially if you already know that the stock is extended in price and in time. And I want to show you some more examples. So these are all stocks I have on the watch list, and I watch them carefully, but I don't trade them right now. The reason is very simple. I wait for a correct new base. What I want to see is that the stock will go sideways for a couple of weeks and reset the clock so that it build out a correct base and then a new trend starts. And when you look here at, Harrow Health, for example, is this a stock which is extended in price and in time? I would say yes. Because if you look back here to the original base, so this one is, let's measure the distance. This is up 115-160% right now. And it trends since a couple of months. So this needs some reset to be attractive to institutions and investors again. And look at how often it pulled back. So here is a pullback, here is a pullback, here is a pullback. So it's already at least the third base, and now it moved very quickly in a narrow channel, and that already shows me there is some distribution going on. So that's a stock I avoid to trade and just monitor it. Here's another one, IAS. So this is a stock I'm watching since a couple of weeks now. I'm waiting for a correct base. Maybe a correct base will come, maybe not. Is this extended now in price and in time? I would say it depends. I would say it's not extended in time. You can see here it the uptrend only ran for 5 months here. Is it now extended in price? I would say. So let's look at that. 74%. Yes, it's a little bit extended, but not too much, because this is a fast moving stock. But when you now look at the pullbacks here, so first pullback, second pullback, this one is not a great pullback here, but this is also the third base right now. So it pulled back many times in a row, and now it started to accelerate. And the thing what I would expect from such a stock is that sooner or later will have troubles to move higher, because already it's on the list from so many people, and it's already extended a little bit in price and in time. And the more extended it gets in price and in time, the less potential you have to the upside. So usually, and we will see that with more examples, so I can also here look at IPAR. So usually the first move, this one here, is a little bit more powerful. It is able to move faster and also generate more profits. Then you have the second move, which is usually also okay. So it can produce a lot of profits, but it gets a little bit more volatile. And then you have the third move or fourth move. And these moves are less powerful, and they are also very choppy. They can become very volatile, and it will be very difficult to hold on to the stock. The reason is simple. So everybody knows the stock, and there is less demand for the stock. So, and if you look at IPAR here, they had earnings today, but this is a stock which is extended in price and in time. The trend started here in November, and it moved, almost 100%. So if you look at the chart here, you can see it had 3 bases in a row, then a fair breakout to the upside. It tried to break out of a rising channel, which is also very difficult for the most stocks, because you need really demand and power to break out. And then, it fell back here and retested the EMA 65. Now a new base could develop or not. But if you look at the chart and you hide the recent price history, you can see this is not a stock you want to hold on for a couple of months. So this is a stock you want to sell into the strength. And Nvidia is another one here. Is it extended in price and in time? Let's look at that here. So 55%, that's a big move for Nvidia. So, and it already trended now since 5 months. I would say, no, it's not extended in time, but it already moved a lot. So, and here you can see what I drew in a scenario for the members. So I said, hey, be a little bit careful with the stock. It can go sideways here, and it's exactly what the stock is doing right now. So it's not very powerful anymore, and it starts to move sideways. And if you look at that here, so this is the first move, very powerful. Then you had the second one, which was not so powerful, and then a third one here, which is also not so powerful anymore. And now the stock really struggled and goes sideways. Of course, it could accelerate here to the upside, but the probabilities are getting lower and lower and lower, and the potential is getting lower and lower and lower. This is why you should focus on buying the first base and buying the second base. Another example is Technoglass here. Very volatile trend, then it started to accelerate and it becomes very choppy. And the reason is simple. If you look here where the trend started, that was in November. So it's already a little bit extended in time. And let's look at the distance here. 100%, yes, this is also extended in price a little bit, and then it starts to struggle. You can see that here what I drew in for the members, where I said, hey, you have now 3 fair breakouts in a row. Be very careful with this stock. This is a sign that the demand is getting lower and you want to stay away from the stock. So, and I want to give you another example from the opposite side, and this is LVS, Las Vegas Sand. So, and here you can see, first move, first pullback or base, second move with a little bit lower potential, second base, and then a very strong move here to the upside. So this is a little bit an exception. Usually the third move isn't so strong anymore. But what the stock did afterwards is exactly what I want to see. It built a new base. So you can see it retested the EMA 65, it had a correction, it shook out a lot of people, and then it set up correctly, and that's why we bought into the stock here, and I still hold it today. Yes, it's a little bit struggling here, but it looks okay. There is nothing wrong with the stock right now. And this is now, this is now the first base after the breakout. So, and the stock is in a young and new uptrend, and it could move higher from here and build another second base and maybe another third base. So this is a younger and fresh trend, what you want to have and what you want to see. So I hope that you understand what makes the difference. So to sum it up again, make sure you buy a stock which is not extended in price and in time. So look at this one here. Make sure you buy the first or second pullback. Be very careful with the third pullback. If you buy the third pullback, in that case, you want to take profits very quickly. And always have in your mind that the more the stock gets extended in price and in time, the less demand is there for the stock, and the potential is becoming lower and lower. So, and this is what I also teach to the members, so that they are able to select trends, very young trends, where a lot of potential is there, and you can make some profits on the side. So this is really, really important. A very small trick, but I think it's very helpful for the most traders to avoid trading extended stocks which are extended in price and in time. All right, if you want to try out my member service, you can do that 14 days for free. And if you want to learn a little bit more, I suggest to subscribe to my free newsletter. I send it out every Sunday with trading tips and stocks I'm watching. And of course, I also recommend my video course, so the Growth Traders Toolbox, where you learn a lot about growth stocks and a lot about trading stocks.